Sales are at $371,000. Okay, that doesn't even cover the increase, or that barely covers the increase in the accounts receivable. Okay, let's 2050 divided by 1679 is a 22% increase in sales. Okay, not enough, not high enough. Okay, let's look at the margins. Okay, so the gross margin is 2050 minus cost of goods sold of 1538. So 2050 minus 1538 is 512 divided by 2050, which is 512 divided by 2050, which is 25%. Okay, let's see what it was the previous year. It was 1679 minus 1343. 1679 minus 1343 is 336 divided by 1679 is 20%. Okay, so they've increased their gross profit margin by 25%, from 20% to 25%. Okay, but they're not selling enough. Remember that DuPont ROE, okay, is equal to net profit margin times total asset turnover times assets to equity. And so what? They've improved that. But this has gone into the toilet. All right, speaking of net profit margin, let's go ahead and look at their net profit margin percentage. So it's 143 divided into 2050. So 143 divided into 2050 is 6.98%. And 125 divided into 1679 is 7.4%. Is that right? $143 divided into 2050. Yeah. And 125 divided into 1679, 7.4%. All right, so the net profit margin has actually gone down, and I'm sure that's because of their interest paid went way up. So this company is a mess right now. Let's ask one more question. Let's see. And sales. So question number 4. So the gross margin went up, but the net margin went down. So should the shareholders, bottom line for this whole case, what is the problem? The problem is the company has spent a bunch of money on accounts receivable and on inventory and on property, plant, and equipment, and they have increased their sales, but not by enough. So whether you're happy or not depends on your belief in what the future looks like for the company. If they've made a big investment and you think it's going to pay off, then you're okay with taking a hit like this. Why is the stock price falling? Because investors in the marketplace see the deterioration in the efficiency and in the liquidity of the company, and they're worried about it. And we could look at leverage. Let's take a quick look at the leverage of the company. Let's look at assets to equity and do that real quick just to get one more glance at a ratio that'll tell us how leveraged they are. So let's go ahead. So we have 2913 divided by let's see, 792, and we have 1247 divided by 692. So let's see what we got here in terms of leverage. 2913 divided by 792 is 3.68, and 1247 divided by 692 is 1.8. So this company has geared up. They borrowed a bunch of money, they bought a bunch of assets, and they're not seeing a return on it yet. So the question is, what happens in the future with this company? All right, that's it. Now, management has made these decisions. How will it play out in the future? And that's what business is in business to do. Take a risk, buy assets, hopefully generate a good return. We haven't seen that yet, but we're still early in the process. All right, peace out. Shalom.